what happened over here? Let's see. Start video. I'm with you guys in 2 seconds. Me. All right. I don't know why that happened. Hello. All right. Let me just see something real quick. I want to make me. Okay, so I should be host again. All right, cool. Let's get started. So welcome. And I actually think today might be a quick call for a couple of reasons. One, if you knew what RHINO Day looked like today, you would say, Ant, I'll see you next week. But no, we're going to get it all done today. Hey, Deborah. And Deborah's already in my text messages today. She slid into my DMs. Love Deborah. Good morning. So, Gunny, good morning from... You know what? I was actually thinking this morning that I need a vacation. And I want to go away to like somewhere with sun, where I can just sit in the sun for a weekend. So the fact that you guys are really like, hey, good morning from Florida, it has me thinking it even more so. So that's that. So good morning. This morning we're going to be kind of quick because we don't really have much to go over, right? So every morning we do a bit of a tutorial, and we've seen the markets coming in. And we've been picking our spots, right? We've been very successful. We understand you never need to go ahead and make a trade down on a daily basis. Let's just see where things are. So now, where did we leave off yesterday? We left off yesterday that we did have a couple on the super duper duper list. And the super duper duper list, for those that are new, is our proprietary algorithm that's able to identify stocks that measure a level of exhaustion that we find a high probability, and then identifying and turning into a purchase, right? Hey, Ecuador's in the house. Love it. And in fact, we only have like 2 or 3 because the market's been so volatile, up and down, up and down. And for those that have been part of this daily program for at least the last month, you've seen us make money going up and money going down, 40% each time, right? In fact, we were able to take a short position in front of the biggest loss ever in any company ever for the entire history of the world. And that's not an exaggeration. Facebook lost $260 billion in market cap the day after they reported earnings. We had a short position going into that. So does that mean we're so great? No, we got lucky, right? Like we understood the direction and the magnitude was the magnitude. Melanie's in that. I gotta tell you, I can't, I'm not going to embarrass Melanie with just spending the next hour talking about my relationship with her, but Melanie in the house is a big deal. And of course, it's on a day that I'm like, all right, we're doing something fairly quickly, right? Hey, Rod's in the house. Rod, I emailed you last week. I didn't get an email back. Just letting you know that I'm waiting for that email back. So I do need your help, and I would like you to help us a little bit. Okay. So yesterday we left off. Yeah, no. Okay, so Frida, you're getting ahead of me. So there's a couple of things going on, right? Everyone's here. Ron's here. Ron, I messaged you back in the RHINO feed. If you could do me a favor, go ahead and email me. We need to talk. Either you can email me or book a call. You are a friend. Let's talk. No more on the RHINO feed, though. Okay, everything. All right. Oh, I love that everyone's so energetic. Everyone's like, I'm here. Like the group that we have today is amazing. Love it. Oh, okay, so let's calm down. Everyone calm down. Everyone take a breath. Usma. Okay, so the market's been volatile. It's been up, it's been down. That's fine. You always got to go back to your initial belief. And it's not initial belief in the sense that I'm unwilling to change what I believed in the beginning. No, initial belief, and I guess initial is probably the wrong word. Overarching belief. Do you believe the circus is in town or not? Where do you think the circus is going to be? Because when the circus is in a particular location, you want to participate in that particular location because then you can make money by falling into a pile of manure because someone's like, hey, kid, I'll pay you 10 an hour to go scoop up the manure. The circus is in town. There's elephants pooping all over the place, right? Like we have so much money. We have so much customers. I don't care. Here's 50. Here's $50. Just go clean it up so people can stay coming. And what we've identified was at the top level, if you're a professional money manager that manages billions of dollars, I was gonna say trillions, but let's say billions of dollars. The first thing you have to ask yourself is, where is my asset allocation, right? Do I believe that money is best treated in the public sector for the next 10, 20 years, or the private sector the next 10, 20 years? Meaning public sector being government and private sector being corporate America or corporations across the globe. And in that calculation, you would then inevitably go over balance sheets, cost of funding, inflation risk, a whole bunch of different things, right? Okay, if I lend money to the government, how do they make their money? How much money do they owe? What's the inflation rate of the money? What's the interest rate on the money? Great. What's the growth of those tax receipts coming in? Great. Take a look at corporate America, you do the same calculation. And what you'll soon find out is that the reason that the public sector always has a very solid demand is because it's guaranteed. So if you're a pension fund, or you're a hedge fund, or a sovereign equity fund, whatever, your number one, for people that believe managing stocks is about making money, you are so wrong. That's on a very low scale. That's on a retail level. That's on a you and me level. Okay, I bought this stock, I made money. I bought this stock, I made money. Blah, 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 blah. On the highest level where you're managing billions, that is not the goal. The goal is, how do I go ahead and guarantee this money and offset purchasing power decline, right? So if I have $1 billion and I give it to a money manager, I don't look at that money manager to make me more money. I don't need that. I'm a billionaire. I have a lot of money. I conceivably can make my own money. I don't need this bozo doing anything to go ahead and take away from the hard work that I'm giving him. I need him just to guarantee it to me, because I can't put $1 billion in a bank account. I can't put $1 billion under a mattress. And I need him to go ahead and offset inflation. Well, if my money goes down 5% because the inflation rate's 5%, so I can only purchase 5%, I'm going to purchase 5% next year. I want to know that that's being taken care of. I don't want to give you money that's worth less than when I get it back, because if so, who are you? What's the point? That's what people manage at the highest level. It's not return on capital, it's return of capital. Meaning at the highest level, when you go ahead and decide where you're going to put that money, you have to take a look at the next 10, 20, 30 years of those metrics. What's the growth in tax receipts? What's the GDP forecast look like? What's the cost of money? What's the inflation deflation rate? What's the bond? What is the debt levels? Is it increasing? What is the monthly trade imbalances? That's what you have to look like on a government side. But a government's guaranteed you're going to get the money back. So you always have to have a certain portion of your money there, because also it's a coward scheme, right? Like if you're money managing and you go ahead and put 70% of your client's money into bonds, and say, for instance, bonds default for some odd reason in the US, even though on a calculator you could have predicted that, the guy can't sue you because you're like, hey, the US government guaranteed it. You want to sue me in a US court because I believe the US government guaranteed? You'll never win. I'm always good. Therefore, there also is a career risk that's associated with somebody putting your money in government bonds. There's always going to be money that goes to the public sector. Now that works till it doesn't work. And as you can see, that artificial money flow has a potential to be an area of blow up at some points, because it never should have been there. Money is going to a destination that doesn't deserve it. It's just absorbing it because it's giving it guarantees and it's giving it career immunity. So when you're playing at the highest level, you have to decide, well, where do I want to put it? Well, at this point, we can go ahead, and we spent yesterday doing it, so I'm not going to bore everyone with it today, even though Melanie's on. I'm not going to go through the 40 minutes of that amazing presentation we gave yesterday, but in fact, I will go ahead and send the replay of it because it really was that good. When you're deciding where to put the money, you have to take a look at, okay, the government owes this much. This is the inflation rate. This is what would happen if they raise rates. This is what happened if they don't raise rates. To go ahead and give you the skip to the end portion, if they raise rates, you will have a blow up in the government bond market that you have never seen before. That will be the step to bankrupt this entire nation. And in fact, I'd like to amend something. Yesterday, I said there was no way in God's green earth that anybody, any Federal Reserve, anyone could be so and I didn't say stupid, I said silly to go ahead and raise rates, knowing that the tidal waves that they'll do in the bonds market. And again, if you raise rates, you lower the price of bonds. We have 30 trillion in bonds. We can never pay that all back. The country's only worth 26 trillion. 3 trillion comes in tax receipts. Therefore, if you go ahead and piss off 30 trillion worth of people and tell them you're going to lower the value of their bonds, and then they sell the bonds, the interest rate goes up and you can't afford that because you can't afford where it is today. That's the short version, right? Like, we'll give you the replay for yesterday. But then I was thinking to myself, I don't really have confidence in this president or these politicians or anyone to go ahead and confuse them for being smart. In fact, I think it's very easily to confuse them for being conniving, to think that they are smarter than everyone else while not realizing that they're actually the silliest person in the room. So I do think there is a chance that in some misplaced calculation of I'm gonna be too cute, that they think they have a deal with bondholders in other countries and say, hey guys, listen, we have to raise the rates at least once, but we'll only do it once. We'll say we'll do it a lot, but we just have to do it. So listen, don't listen to what we say on TV. I'm guaranteeing you we're only going to do it once. Just stay put. Because if you ever raise rates and lower the price of all the bonds, and there's 30 trillion worth of bondholders all understanding they're going to lose money, they're going to sell. There'll be a mass exodus because that artificial money flow is in there. Money is not in the bond market because they believe they're going to make money. Right? If you take a look at the US government, we have a 7% inflation rate, but a 1.9% 10-year bond rate, which means if you buy a 10-year bond, you're guaranteeing yourself you're going to lose money. You're guaranteeing you're going to lose 5.1% purchasing power every year for 10 years. Why would you ever do that? You wouldn't. It would just be insane to do that. You would never buy something guaranteeing yourself a loss. So you must think that there's either deflation down the pipe, or that they're never going to hurt the value of those bonds, or that they're constantly going to do a monetary easing where the Fed's going to purchase the bonds, meaning you're always going to support the price. If you raise rates on bonds, you blow all of that out of the water. You say, guess what? We are going to lower the price of your bonds. We're going to do this, 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 and this. Therefore, as a bondholder, you're like, all right, guys, well, then see you later. Take all them back. And then the price crashes, yields spike, and the country goes bankrupt. And if you think I'm being overly hyperbolic, I just need you to grab a calculator, right? Like, so we'll spend a minute doing this. Okay, here's my calculator. I owe $30 trillion. I pay 1.9% rate on that every year, an interest rate. That's a 10-year rate. I make $3.5 trillion a year. I'm the US government. $3.5 trillion comes in the form of tax receipts. $3.5 trillion of 30 trillion is 12%. Meaning if that bond yield goes to 12%, I cannot fund anything in my nation. I cannot fund a postal worker. I cannot fund a policeman. I cannot fund a congressional salary. I can't fund anything. Therefore, at 12%, I'm not only bankrupt, but I have a whole nation that wants to off with my head, right? The nation blows up. That's what happens. The nation is over. The American experiment is over at that point because you cannot even afford to pay anyone. The only way you could do anything about it is to go ahead and print that money into oblivion and say, hey, I have a printing press. I could pay everyone because I could just print the money. And then everyone says, oh, see, here's what you don't get. Now we don't trust you because your currency is worth nothing. Therefore, we're never going to lend you money. And your currency is not going to buy anything. And you have a level of hyperinflation. My point is, you would say, Anthony, that is even too doomsday for me. Like, that's a scenario that's out of control. I agree with you. I think that scenario is really, really bad. I think that scenario is like the end of Revelations, right? Like if you read the book of Revelations, it's like the last page. The point is, from here to there, the pathway to it is raising rates. Because the second you raise rates, you are now poking the bear of ground zero. Ground zero is the bond market. Why do I say that? Because the entire sovereignty of a nation rests on the debt that it owes. This nation owes more debt than it's even worth. If you go, we've been guaranteeing everyone that we're going to pay them. And the way we guarantee it is because we're printing money out of oblivion, because we have a printing press. Now, that's an overly simplified version. I get that. But in currency is trust, right? In God I trust. That's fine. You could actually, you know what? Most people say, well, hyperinflation is just an increase in money. But it's not. In fact, in In 1922 Germany, the reason they got to the Weimar Republic of hyperinflation wasn't because they kept printing money. It was because the government said, hey, listen, we're going to, what's it called? We're going to confiscate 10% of everyone's checking and everyone's bank account. We're taking 10%, and we're taking that 10% and substituting with a bond for the government, right? Like, we're going to take $100 and we're going to give you a $100 bond. Hey, listen, it's a bond. We're going to pay it back. We guarantee it. In fact, we're going to give you an interest rate on it. So you should be happy and shut up. People then said, whoa, if you think it's okay that you can just take my money, well, then all bets are off. I don't want to own this currency anymore. I don't want to own anything in Germany anymore. I want to own the British pound and this and that and this and that. And that's when the inflation rate, the hyperinflation really kicks in, because it's not that you have too much money, it's that no one trusts the money anymore. It's just monopoly money at that point. That's what this nation would look like. So you can't exactly do that. And it's been our contention since day one that if you have an inflation problem, and the inflation problem was because COVID came around and the money got pushed into the real economy, right? So I feel like I'm giving the presentation of yesterday all over again. I'm going to try not to. When the government wants to borrow money, when they need money to do anything, right? Like pay their congressman $1 billion. Like when they need to pay Dr. Fauci $450,000 a year because he's saving the world, they need to go ahead and sell bonds. Nobody in their right mind would ever buy that bond, because on the merits of the economics of this nation, they can never pay that back. You would never do it, and you would never do it at 1%. So what the government did in their infinite wisdom is said, hey, well, we have a banking sector. That banking sector borrows from the Federal Reserve. The Federal Reserve has the ability to print money out of thin air. The banking sector, if they borrow from the Federal Reserve, they're borrowing it. They're going to give it back, so that doesn't increase the money supply. But the money they borrow, they can then use it and buy the government debt, which means the banks keep the money within the banks. They get an interest rate on the banks. The Federal Reserve never increased the money supply, because what they're lending out, they get right back, which is a complete shell game. Give me $10 and let me borrow another $10 to pay back past $10, and the government debt gets purchased. That's how that works. But because none of that money enters the real economy, you never see an inflation rate, because there's never an increase in money supply versus goods and services in terms of velocity of money. You can have an increase in money supply versus goods and services, and as long as they never connect, it's fine. It's like if you have 10 girlfriends, if they don't know each other, everyone thinks you're their only boyfriend, right? That's the way the money supply works. But once the bank says, hey, Kimberly wants to go out on a date, and now the money comes into the real economy and Kimberly meets Kelly, you got a problem. That's what inflation was. So once COVID happened and all of the money had to go through enhanced unemployment, payment protection programs, and came into the real economy, you had not only a supply line crunch, right? A supply line disturbance, because all the economy got shut down. Therefore, the supply, what's the word I'm looking for? Supply, whatever. So because the economy got shut down, you supply chain, thank you. Look at Melanie. She's like, Aunt, I got your back. So once the supply chain got disrupted because the whole economy got shut down, and now you don't have workers, you don't have production, that's fine, because everything got shut down. It's a market. The supply met the demand. The demand was zero. The economy was shut. Now, once the economy opens up, when everyone has a bunch of money in their pockets because they've been having their mortgages put on hold, their rent on hold, their phone bill on hold, but enhanced unemployment, payment protection, they finally get to go out and they say, hey, I have all this money. Let's go YOLO. You only live once. Now they're buying stuff. Now the distribution's not there because the supply chain got cut in half. Now the distribution has to go ahead and hire new people to go ahead and rehabilitate all the things that they were supposed to have. Therefore, that increase in money supply versus the very limited goods and services equals a higher price because there's more money chasing fewer goods. That is inflationary by the numbers. Now you could say, Ant, that's not really inflation. That's just supply chain. Well, you don't have the opportunity to go ahead and make that argument. Data is data. You can interpret it that way, but if everyone interprets it another way, it doesn't matter what you interpret it. So you have that going on. And then as a result, all these stocks are going through the moon and back because the Fed is pumping money into the system. They're quantitative easing. We're never going to raise rates. So everything has a valuation based against what's the cost of capital. What's the cost of capital? It's zero. What's my alternative to stocks? Nothing. Rates are zero. Where am I going to put my money? What am I going to not buy stocks and buy a bond at 0.3%, which it was in March 2020? Therefore, the money goes to stocks by default. So stock markets fly, people have money, prices go up, inflation, 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 inflation. So what the Fed is now saying is we have to raise rates to combat that inflation. But my argument is that, does that even make sense? How do you combat that inflation with raising rates? Well, the way they believe they're going to do it is by raising rates. You're telling all companies that their cost of capital in the future is going to be higher. Therefore, you have to value them at a reasonable valuation today. If I'm a new tech startup and I know that I could borrow money at zero, I can conceivably dream the world up because I could just keep borrowing money and funding it. Now, if all of a sudden the cost of capital is 10%, I have to at least pay that. So I have to be profitable enough to at least pay my interest back. Therefore, I can no longer be valued at what I was when the cost of capital is zero. If I'm a holder in stocks, well, every company is going up. I have a wealth effect. I have more money in my bank account. I have more money in my stock account. I can sell things, move it to my checking account and go spend money because my stock account keeps going up. My home keeps going up in value because people that can't go ahead and buy stocks or send stocks too high, they go and buy real estate. Everything's going up. Well, what happens if you raise rates? Well, now that flow of funds gets cut off. What the Fed then says is, not only are we not monetary easing anymore, we're not just printing money at left and right, but we're actually going to raise rates from zero. So therefore, the party's over. The free money's over. Meaning, if you don't make a profit now, you're likely going to get sliced in half. And if you do not have a plan to make a profit in the next 2 or 3 years, you're not going to be able to fund your cost of capital. Therefore, your company is worth far less. If your company is worth far less, then your stock account's worth far less because the people that made all the money wasn't because they had good jobs. The economy got shut down. It's because they own stock. So if stock value comes down, their account value goes down. What happens when your account value goes down and your net worth goes down and your home prices aren't accelerating like they used to and your stock account is killing you? Well, now you say, whoa, I don't really want to spend money like I did last month. Last month I was a millionaire. This month I'm 100,000 Let's kind of slow the money down. Now you're decreasing the money supply first, chasing goods and services. Well, those goods and services is simply a supply chain that goes ahead and improves every day. In fact, you could make the argument that if you suck all the money out of the stock market and allow the supply chain to move forward, well, you have the natural vaccination rates and the economy reopening. That inflation rate that was 7% because it was 7% over 2020. Now, remember, in 2020, what happened? The economy got shut down. There was no rate of anything. Therefore, in 2021, 7% higher than 2020. Well, duh, the economy was shut. Now take those comparisons and say, what's the rate of change of 2022 over 2021? And 2021 was over 2020. You would say, well, 2021 was really unprecedented because you had a rate of return that was higher than a shutdown economy. I don't think we're going to have the same this year. So if your natural inflation rate is going to be lower, your supply chain has gone ahead and got rehabilitated, and the wealth effect by the money being sucked out of the stock market happened just by the Fed saying they're going to raise rates. Do they really need to continue to raise rates? I think their job's done. I think their work is done. I think by simply just saying you're going to raise rates, you went ahead and accomplished the goal of the inflation you're set out to go ahead and attack while still preserving the valuations of all the bonds, of all the people that own those bonds, and not pissing $30 trillion worth of debt holders off. I own a company. If every one of the people that have money in my company all collectively said, hey, you pissed us all off, we all want our money. Yeah, we can do that, but you know what would happen to us? We'd have a real problem. We'd be out of business because we wouldn't have any funding. All of the things that we do requires, okay, this money's already allocated there and this money's already allocated there. Sure, we can do it, but like the country, you'd have a real problem. So you never want to go down that road. The difference between us and the country is we actually manage our bills. The country has a printing press. They don't. So they never want to go down that route. All right, I get it, right? This seems like it makes sense. And maybe I don't share the passion you have, but I understand it. So why at that top level would someone pick stocks over public sector, over government? Well, the answer already happened, but let's go a little bit further, right? If you go ahead and put money in the government, do you really want to be a part of everything we just shared? Because at the very least, you can say, at the very best case scenario, you could say, well, that's a minefield, but I think the government will navigate it. Well, I don't know if you've seen who's in like the Capitol lately, but even in the best conditions, I don't think anyone that's a politician can navigate that minefield to begin with. But okay, America hasn't gone out of business yet, so they have navigated it. Fine. That's your best case scenario. Your best case scenario is you want to go ahead and participate in that minefield. Well, then you're cuckoo for Cocoa Puffs, right? Because what's the worst case scenario? That minefield blows up, and then what do? Okay, so if I don't want to be a part of that, where do I put the money? Well, let me take a look at the corporate sector. Well, COVID annihilated small business, middle class got wiped out, meaning all the largest companies went ahead and vacuumed up all their customers. All the largest companies have billions and hundreds of billions on their balance sheet. In fact, Apple right now could buy an island and be the 5th largest country in the entire globe. Let's take a look at Apple's balance sheet. They have $200 billion in cash. They have how many billion iPhones in existence? In fact, if Apple owned an island, they'd be the 5th largest country with the largest population amongst any country ever in the history of the world. All right, well, Anthony, that's kind of interesting. I never thought of it like that. Apple's a company, not a country. But if Apple said, I want to go ahead and buy Australia, and Australia said, we'll sell Australia to you, do you think Apple can go ahead and create the most prosperous country ever known to man? It sounds like a real tricky thought experiment, but the answer is yes, they could. So if that's the case, do I need to see them buy a country to know that they're where I should put my money? Well, Ann, we're talking about government and corporations. What you're comparing apples to oranges, but I'm not. Just because this person has blue hair doesn't mean they can't change their hair to green. And if they could change their hair to green and at green hair, they're the best thing ever, then I'll just keep that in my mind. I'll keep it as a secret. And I know to myself that I could buy this weirdo with blue hair and be completely fine with my life. Therefore, when you take a look at the corporate sector, you can see examples of this all over the globe. Do you know Google? Do you know Amazon would be like the 4th largest company, the 4th largest country in the entire globe? Do you know the NASDAQ 100 could be half the world's GDP tomorrow? Now, I know what you're saying, Anthony, these are companies, they're not countries. I get it. But they have a CEO, is that not like a president? They have board members, is that not like the Senate? They have customers, is that not like citizens? My point is, when you measure them all up, you can very quickly see, all right, if I squint, they're kind of the same. I know they're different, but if I squint, they're kind of the same. And this has such a great balance sheet, and they're making money and they're paying people and everyone's happy. Over here, everyone hates their life. They have no money. They can't afford to pay anything, and they're walking on a minefield. Therefore, me as a money manager, again, right, like wearing the money manager hat, I'm going to put my money in the corporate sector. But you're saying, Anthony, but stocks, they're getting annihilated. The Fed might raise rates, stocks are going down. Well, let's go back to what we believe the Fed is always intended to do. By it's called jawboning, by jawboning the market, by saying, we're going to do this. They've already accomplished what would happen if they did do it. Therefore, if they've already accomplished their goal, do we need CNBC to tell us, oh, well, looks like the Fed already accomplished their goal. They're really, really good. If I was you, I'd go buy stocks. Do I need CNBC to tell me that? Or do I have a brain and I can think of it myself? Can I observe it myself? Do I have the confidence, the courage, and the experience to see and know it for myself? And I think the answer is yes. Therefore, I don't need anyone to tell me that their goal is already accomplished. I can do math. Therefore, if that's the case, well, when the general consensus is these guys were actually just talking, and maybe they do a rate hike just to show that, like, you could believe them, but they would never do more than that, then what's the opportunity in the stock market that's pricing in a cost of funds much higher than it's ever going to be? Well, not only did we take a look at them and say, not only these balance sheets and these companies bigger than countries and could be the most successful, I want to own them, but they're at a severe discount compared to what they're going to be based on the analysis that we're able to intelligently see. Therefore, if I would buy these apples to apples and I'm getting a 10, 15, 20% discount on this, then why wouldn't I? That's money managing on a very professional level. And when I say professional, I mean bigger than the people out there, because I never want to say, oh, I'm smarter than them or I'm better than this, but the performance speaks and we are better than all the other people out there. In fact, I would go ahead and welcome the competition of anyone bringing their money manager or any kind of program or putting me anywhere, and we could talk to them very easily. And let someone tell me, well, Ant, you don't know what you're talking about. I would be able to show them the error of their ways very quickly. So the point then becomes, okay, Ant, I get it. You want to buy stocks. All right. See all the things that we just did? That was just to get to the point of we want to buy stocks. Now, when do you buy them? What price do you buy them? What stocks do you buy? Where's the point, right? That's where the other work comes in. That's where the technical stuff comes in. We need to take a look at the volume. We need to take a look at who sold. We need to take look what's exhausted, what's going down on bad news, what's going up on bad news, blah, 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 blah. But if we take a step back and say, all right, Anthony, let me ask you one question. If I buy something today, will it be up a year from now? I would say 95%. And I only say that because I don't know if we get into a war that I really don't trust this government. I think they're like, if you've ever seen the movie Weekend at Bernie's, I think that's what the White House looks like, right? And that's my personal opinion. So 1 year, you have midterms. I don't know what these cuckoo birds are going to do. Maybe COVID happens and they need to do more mail-in ballots, right? I have no idea. But if you ask me, Anthony, okay, 2 years from now, if I buy a stock today, will it be up or down? I would say up. And without saying guarantee, I would say 100%. And you would say, well, Anthony, 100% equals guarantee. And that's where I'm not talking to anymore. We do not say the word guarantee. But I think, in my opinion, 100% of the time, if you buy the overall stock market right now, it will be up years from now. In fact, in my opinion, I believe the stock market's 65,000 by 2030. It's now 35,000, which means it's, in my opinion, it increases 4,000 per year for the next 8 years. That's 300 points per month. So if I think that, well, why wouldn't I just buy anything? In fact, if I think that, then do I care the market comes down an additional 10%? No, I don't, because I would buy it more then. So what does that mean for anything we're doing today? Well, actually nothing. It just means that we know where the circus is. But because on our platform, we trade options that have you're counting cards. And you're basically saying, I believe this stock is going to be at least this price by at least this date, and I'm going to buy a contract that I sign my name to. And if I'm right, that contract is going to be worth 2, 3, 4 times what I bought it for. That's not investing. That's trading. So everything we shared with you was investing. Now we're going to talk about trading. You do need to know how people invest to trade. Because if I go ahead and go to India and I order a hamburger, I have a problem. Now, why do I have a problem? I love hamburgers. Well, I need to know where I am. They go ahead and worship cows. You cannot do that there. Therefore, you have to know where everyone's mindset is to understand how to navigate going forward, because a market is just people's mindset. It's behavior, it's emotion. It's people trading their emotions, right? So with that said, 2 things come to mind, which is why I thought this wasn't going to be long, because I do have an 11 o'clock call. So I'm going to make sure this isn't long, but I think I might buy something today. So 2 things. Actually, 3 things. Yeah, 3 things. PayPal, Facebook, Lucid. Now, what do these 3 things have in common? Probably nothing, right? Like, they're in the NASDAQ, right? PayPal got annihilated. It was a $350 stock. I think it's like $110 or something right now. But regardless of how bad PayPal's business is in terms of their expectations and their revenue and all the rest of it, the thing that they actually really do have is customers. They really do have data. They really have accounts linked to other people's bank accounts. They really have companies that are depending on them for money flow. They have people that own businesses and or are comfortable with mobile banking. They actually have that. And I don't know the number of it, but I think it's like 20 million or 200 million. It's a very large number, right? I don't know it, but PayPal was number 1 in the game. So let's just agree that it's a very large number. So if I was a brick and mortar bank, like if I was JP Morgan, well, I don't have that. In fact, I know I need to have that because I can look at any analyst of any of the millennial generation and generation Y, Z, X, W, apostrophe Z, like whatever they are, and say, well, these guys aren't going to walk into my bank. And in 2030, you have the biggest wealth transfer ever in the history of the world because the baby boomers are starting to get a little bit up there in age. God bless them. They're going to make sure that heaven is beautiful for all of us. But in doing so, they're going to leave their money to the generation underneath them in terms of their wills, right? The generation underneath them is the millennial generation. The millennial generation is going to come into the biggest wealth transfer ever in the history of the world, because the baby boomers have 70% of the wealth in this nation and of the world. Therefore, the millennial generation, who despises walking into a bank, is going to come into 70% of the global wealth. Do you think banks, it might behoove them to say, listen, we need to get some representation of those people? Yeah, those millennials, they don't make any money. The Generation Y, they live in their parents' basement, but they're going to come into a lot of money. So let's go ahead and buy that data now. Let's get them hooked on our drugs so that when they have money, they could buy the super duper drugs through us. If I was a bank, I would do that. In fact, if I was a bank and I could borrow money for free, I would definitely do that. And especially when you see companies like Microsoft buying Activision, and people looking to buy Peloton, and Facebook buying their own stock, and now Amazon buying their own. The money's everywhere. The money's there. They just need to put it somewhere. So if I saw a company like PayPal go from 350 down to 100, and I'm a company like JP Morgan that knows I need to go ahead and develop that part of my business, why wouldn't I just buy them? Well, I don't know. They should. The point of me saying that is I do believe there is a floor that PayPal gets to where people start that chatter, where banks start looking at them, where they maybe do get bought out. So I want to watch PayPal. I want to see when it stops going down, because when it stops going down, it's going to give me, a little bit of an insight to, okay, the market has pulled back enough that we found a level of traction from where the Fed sucked the money out to the transition to when the market makes its next run up. I want to look at PayPal. I want to look at Facebook, because Facebook, I think, is the single best stock anyone could own for the next 10, 20, 30 years. I think they have more data on more people than anyone's ever had. I think they have the smartest person at the head of the company that at least knows this stuff. And their company got whacked because they're reinvesting to create a metaverse. I know it's a cute term, metaverse, blah, blah, blah. How about you take our entire globe and realize that they're trying to recreate it, but better? How do they do that? I don't know. Say you are somebody that's shy to go up to a girl or to a boy. Do you know you could go somewhere in the metaverse, buy a particular piece of hardware that you can go ahead and introduce to your genitals, and in this metaverse, you can have interaction that goes ahead and sends a signal to that hardware that will go ahead and replicate or reproduce or whatever the actual desired feeling that you're looking for is, that you can talk to that person in the metaverse and meet up with them and share all the natural intimacies of a relationship while still growing past that. In fact, they are building augmented reality in the sense that you're going to be able to wear a bracelet, and that bracelet's going to be able to send signals up your arm and through your body that if someone pats you on the back, that portion of your body will feel the pressure. Now, you would say to me, well, Ant, that's some super scientific stuff. Well, that's what they're doing. They're doing it right now. In fact, they're so focused on it that they're letting, they're not managing company expectations of quarterly reports because they're going to create a whole new globe. And in doing so, do you think this company is going to allow you to just shellac them all over? In fact, they have Instagram. What if Facebook said, you know what, listen, we're really focused on this metaverse thing. We're going to spin off Instagram. We're going to spin off WhatsApp. We're going to spin off Messenger. We're going to spin off Facebook. In fact, if you own our company, you now own a share in all of those companies too. They are their own stocks. They're going to hire their own CEOs, and those CEOs are going to focus on those companies because we're focused over here. What would happen? What if Facebook said, we're going to create the Facebook coin? Anyone on Facebook that's going to participate in our metaverse has to own this coin. What would happen to the value of that coin? I don't need somebody to tell me, well, Ant, this is what they're doing for me to buy it. I can very clearly see the options they have in front of them and say, none of that's priced into the stock. In fact, if you buy it here and they do even one of those options, you're going to hundreds of times on your money. So I see Facebook going down every day. Where's the point that it stops going down? Because that's the point that people with brains are saying, I'm willing to step in here. If it goes down, I'll buy more. And you know what? When those people do that, and this is how I know that they're doing it. And then lastly, Lucid. Why do I say Lucid? I don't know. They're like this crazy, not stupid. I know nothing about them. They're like an EV company, electronic vehicles. They're one of the newer ones, right? So they're like a complete moonshot. I don't even know if they're going to create a car soon. Maybe they did. I have no idea. But I know they're not going to be profitable for like at least the next decade. So this is a company that's completely dependent on investor sentiment, right? What do investors believe are the prospects? Now, I think any one of us could say, well, electric vehicles are the future, right? Like we know that. That's not me making up something. So we know that the demographic is going to push towards that. Well, now this particular company, it's successful in its own right. Like it's its own company. They have investors. They're a stock on the market. They are at least making a car. I don't know if they're profitable, right? And here's the thing: you might say, well, Ann, how do you talk about something you don't know anything about? I don't need to. I don't need to know any of that stuff. I know that if they're a stock on the stock market, people at least believe them at some point, right? And I can take a look at the volume, see how many people believe them. I can take a look at the stock and see how many people have believed them when they stop. Like I could look at that stuff. I don't need them to tell me. I know the business that they're in, and that's enough for me. So if that's the case, and there's a company like GM or these other companies that would say to themselves, I know this is the future. Why don't I go ahead? They're already doing it. How about I just buy them and bring them in? I know that they're cheap. The stock got annihilated, but that's an opportunity for us because we need that department. We actually need that because that is the future. Instead of us growing it, we could acquire all their software engineers. We could acquire their executives. We could acquire their patents, their plans, their infrastructure. We could get all that just by buying the company. Why wouldn't we? So that makes sense to me. Now, the reason I say lucid is because now you take all of this and put it into our algorithms. They are a 16 red and green. That's the best we have right now. We don't have anything higher than 16. We have Caterpillar that's 15, but now they're no longer red, they're just green. So, and 16 is where Anthony usually looks to buy something. Now, the reason we're mentioning lucid even more so today is there was a note out of JP Morgan, I think, where this gentleman, in his infinite wisdom, came out and downgraded the whole EV sector. Everything electric vehicles. He said, you're too soon on it. It's not going to happen, and a whole bunch of bad stuff. Well, I'm going to spend a minute on this, right? A stock market goes up and down on buyers and sellers. When everyone bought something, it's when all the news is the best, right? Conceivably, at the highest point, the most optimism, everyone owns a thing. Well, when everyone owns the thing, where's the people left to buy the thing? Which means as long as you understand that, you would know at the peak optimism is also the peak of the stock. And it can only go down from there because there's no additional people to buy it because everyone's been convinced to buy it because it's the peak optimism. That works inverse as well. So when you have a sector that's been slaughtered with the markets going down, like all the reasons we already outlined, I don't need to go over them. But then you have Bozo over at JP Morgan say, yeah, we just decided, because like obviously everything that happened, he was oblivious to, but now he decided that this is the end of the game. It cannot be any more pessimistic. Not only did everyone sell it, not only is the whole everything blowing up, blah, 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 but now you have a really high valued opinion from the highest value bank coming out saying, hey guys, listen, wouldn't touch it. So all the people left that own it conceivably probably sold it there. Now at a 16, do we see 17s? Do we see 18s? Do we see 19s? Do we see 20s? Yeah, it can still go down from here, which means if it's still a 16 red and green, and if it's still down, I'm going to buy some of it. Because if it goes down further, I will buy more of it. And if it goes down further, I will buy more of it. Because my belief is if this thing goes to a 20 red and green, I'm happy with that. I always win at 20 red and green. Do I believe right now we're getting to a point where I can buy it? Yes. But I have to now go ahead and confirm that. I need to take a look at the volume and the market activity in the charts. I need to take a look at PayPal and Facebook and see if they stop going down. I need to see if Lucid is down, but it's hold. There's things that one needs to see. So when you're a professional at this game, everything that was shared with you is important. You have to know all the dominoes. Now you have to go ahead and see if now's the day that the market's telling you that everything you just came up with makes sense. So it's 10:44. We will be done at 10:55. We have 11 minutes. Our goal is to buy Lucid. Let's go take a look at what's going on, right? It's hot in here. Okay. So I had Lucid up because I looked at it this morning. So it was as low as 25.89. It's now 26.40. It's good. It's holding. It's 16 red and green. Let's see where the market is. It's up 72. The Nasdaq's down 7. Let's see where things work today, right? So let's look at the QQQ. And the QQQ is the NASDAQ 100 ETF, but because it is a proxy, well, because it tracks the NASDAQ, you're able to trade it, which means I have volume. I can see price, I can see volume, and I can see volatility. So let's take a look at what all this is telling us, right? Okay. So this is where we're interested, because this is where we are. So we said we were going sideways, which we were. We saw volume coming down. We saw volatility going down, right? Okay. Now, where are we? We're still going sideways, right? You could see that. And volume looks like it's still going down, right? So there's that. And I got to tell you now, volatility looks like it's curving up. And what conscience can I go ahead and buy something when volume's going down, volatility is starting to curve up, and it's just going sideways? The sideways nature is telling me that it's waiting for something. The volume going down is telling me that there's less participants in it, which is fine. But the volatility going up is telling me that the participants that are in it are becoming more volatile. They're starting to get a little more nervous. If the people in this that has less participants and the ones that are in it are getting nervous, then once they start selling, you have less people that are in it to withstand the selling, which means you have a cascade of selling, which means I can't in good conscience buy Lucid because the market that we're in looks more times than not, it wants to still go lower. So let's take a look at PayPal. Okay. So PayPal had these two trend change bars, which say, okay, it's done going down. It since has curved, but can I see something? Okay. But does it look like it's making a run for it? No, in fact, you see the volume going down as the stock's going down, which is very good. That means there's less people selling it. But I see a market looking to become more volatile. Actually, PayPal's starting to look sexy. Now, unfortunately, it's a what? 1, 2, 3, 4, 5 red and green. It's not enough for us. IWM, remember we were talking about the Russell? Look, it's up again. So we do think there's a bid in the market where people are looking to buy stuff. Facebook, 4 trend change bars in a row, which I don't think I've ever seen. That's a lot of volume. Presumably, everyone that could have traded Facebook has traded Facebook. In fact, Facebook got down to 219. It's now 223. So what does that mean? Does that mean we found the floor? I don't know. It closed at pretty much the lows 4 days ago, closed at the halfway point 3 days ago, closed at the lows yesterday, opened at the lows today. It looks like it wants to move higher. Sorry, my nose is itchy. So this is good. It says to us that people are looking to buy stuff. And why do we say that? These are the smallest companies. If they're doing well, then it means either the economy is doing well or that there's a lot of money in big corporations that are probably looking to buy small corporations. We mentioned that which is why this is not a surprise. Facebook looks like it's coming off the lows. It looks like it has some oomph to it. Let's take a look at the volume, though. PayPal, still low, staying at the lows. It hasn't come off it yet. So Lucid, it's off the lows of the day. It got the bad news, hung in there like a champ. It's going down on lesser volume. There's less people selling it. But the volatility of the NASDAQ, I don't like seeing it curve up. But I honestly think that might not be the worst thing in the world. So this is what I want to do. I feel like if I did anything right now, there is a certain hope and prayer that's going along with it. Because I'm seeing things that I like, but it's not enough to push me in the direction. Now, this was down to under 26 before. And full disclosure, I knew that, but I will not buy something before 10:30 because I believe that 9:30 to 10:30 is where all the emotions are happening. And yes, sometimes I might not get a stock I want, but more times than not, I would have saved myself some heartbreak. So I think we have a good position. I think we see Lucid. I think we see PayPal. I think we see Facebook. Caterpillar is a 15. Now it's red and green. Kellogg's is a 14 red and green. This is interesting because this conceivably 12, 13, 14, 15, 16, 17 is really an 18 red or 18 green, could be red. Why do I say that? Because I know how the formula is calculated. I made it. And I'm not going to tell you how, but this is 10 cents away from being an 18 red and green. So I have it. It's interesting. What I think I'm trying to say is because we have all of this in front of us, we have enough options that tomorrow, whatever the best option is, we can feel comfortable. We can either guess which is the best option today, or we can go ahead and select what is known to be the best option tomorrow. And I think when you're managing money, especially when you're trading like us, I think it's best to do something knowing it. And you can never know anything, but you get it. So I'm not going to do anything today, although I really would like to buy something. I'm going to hope that the market pulls back today, or at least starts down tomorrow. And tomorrow, I really believe we're going to buy something. So stick with us tomorrow. We will be buying something for the most part. And I don't see any chat. I see we have a really good group. Everyone, I totally love you. Melody, thanks for participating. And those that don't know Melody, she's in California. So when this started, it was like 6 a.m., 7 a.m. for her. So love that she's with us. And everyone, right? I mean, Frida's in Israel and everyone's all over the place. So anyways, guys, love you. I will see you tomorrow. Bye.